Today, I'm joined with Peter Marrone from Allied Gold. In today's interview, we get into the price of gold and what impact that has on Peter's decision making when it comes to expanding projects or doing more M&A. We also get into the recent production ramp up that Allied Gold has going on in Africa, and we ask about a company which we recently did a video on called Sendero Resources. All right, everybody, enjoy the interview. Peter, it's great to see you again.
It's great to be here.
So maybe today's a day where the price of gold, and who knows where the price of gold is going to be by the time we get this edited and up on our channel. But um, we've seen a $200 price drop in the price of gold. You've been doing this for a long time. You've seen some bull markets and some bear markets and some volatility. When you look at what's happening with the price of gold right now, what's going through your head?
So last night, as I was thinking about this interview, so before this precipitous drop of a couple $100, I thought I'm probably going to be asked about gold price and is there a risk that it falls? And here we are, it's actually happened. And what I was going to say is what I'll say, which is that I think it's natural for there to be corrections. And if something moves too fast, too far, too fast, I think that it's natural that, and frankly healthy, that there should be a correction in that. Look at what we've seen with gold price. The realized gold price for the number of ounces of gold that we sold in our company in the third quarter was just about $3,400. And within the span of what, a month and a half, it's climbed the better part of $900 to $1,000. So I think it's natural to say, expect that there's going to be some adjustment, some correction. It finds a new floor. But then we have to look at the fundamentals. And I think the fundamentals fall into two categories. The first is, fundamentally, has anything changed that would propel gold price to $4,000 and maybe even higher? And I think it will go higher. And the answer is no. All those same reasons that got gold price to the level that it's at today and likely will go higher are still there. So I think that as it creates a new floor, that natural correction, I think we start to see a movement back up. That progression will be more gradual, but we'll see that movement back up. And the second point that I think is important is, and this is one that's near and dear to my heart, because while we look at the gold price and we look at what we manufacture, what we produce, and then what we sell, I look at the share price, because at the end of the day, we are investing in shares in public companies. And when we look at the share prices, except for the super caps in the precious metal space, are still not fully reflecting a gold price of $3,000, let alone 4,100, 4,200, which is where the gold price is at with this correction. So I think we're bound to see some further improvement to the share prices once this correction is done.
So you've been doing this for a long time, and my understanding here from looking at your bio is that you were a former investment banker. So you've sort of seen the whole spectrum of how it works, and I know that when you're going to raise money, there's a whole bunch of I don't want to say games, but there's a whole bunch of negotiation tactics that go on when it comes to raising money to make sure that you're managing your cost of capital effectively for your shareholders. But all that being said, the one thing that I chat with a lot of friends in the space, CEOs, hedge fund managers, um, high net worth individuals, retail investors, the thing that I'm kind of picking up on here is that over the last couple of decades, because there's been such a small amount of wins in Canadian mining, and I know you've been a part of a couple of them. There's just been such a small amount of wins that we're not really left with a whole lot of long only funds and strategic capital that's out there. I know that there's a few like the Crest Cats of the world, but that kind of needs some time to kind of build a base, from my view, where we need these wins to happen and we need people to recycle that into the market and people to go raise lots of money to start deploying capital into the juniors. Do you think that that's something that's coming, or do you think that we're still going to just see a lot of these sort of, net neutral hedge funds that are just sort of funding the market, which is, from my viewpoint, what a lot of Canada's turned into?
Well, I can't speak to some of those aspects of the market that are not that are driven more by algorithm and momentum. There's a lot of that, and clearly that has an impact on the market. That impact can be positive or negative. In the same way as when there's a downward trend, it exacerbates that downward trend. If there's an upward trend, then you've got this wind in the sails that pushes the share prices higher. So I'm going to consider that to be a bit of a neutral event, because the rest then depends on what's happening with the metals market and what's happening with the company, a particular company, and the industry more generally. But in the context of the industry, I think that there's been significant improvement, certainly over the last decade, in terms of how capital is managed. Uh, we look at, as participants in this industry, we look at growth and the importance of growth, but it has to be disciplined and managed growth. Don't spend hordes and hordes of capital dollars on something that does not deliver a return. And you shouldn't be looking at returns based on, hey, guess what? Gold price is going to go higher. So I think that discipline's really come into the market, certainly for the producing companies and for many of the development stage companies. But when you asked about the investing public, and there's again, unquestionably, there's been a significant erosion to those investment dollars, to those funds that are in the resource space. Many of them have been decimated. Some don't exist any longer. But this is a sector, and as the sector begins to perform, and as the share prices demonstrate that there is upside, then I think that there will be new investors and there will be new funds that come in. We have not yet seen the those new funds in hordes coming in. But here's the good news. The good news is that this is a very limited, small sector. If we look at the market capitalization of the entire sector, we're talking about a fraction of one of the big technology companies, and that's all of the mining companies combined into one. So when you start to see that investment coming in, certainly from the generalist funds who begin to dabble and then come in more earnestly, you've heard me say this before, but I'll say it again. It's important. It'll be the equivalent of a Niagara Falls volume of water through a garden hose. So there's going to be a very significant flood of money coming into the sector. And I see a lot of other sectors where the multiples, pick your poison on what? EBITDA, enterprise value, net asset value. The multiples are impressively high. And we're not seeing that in the precious metal space. Even the super caps are trading at one half of the multiples in some of these other sectors. So I fundamentally believe that the share prices are not reflecting the gold price, and they have considerable upside. Even if that gold price is only $3,000 an ounce, I think that you can see some pretty significant upside in the price of shares. And certainly that's true for Allied Gold.
So I guess that the big takeaway here, and that's not financial advice for anybody in the audience, but just from what I'm gathering, is that whether gold has hit a top here at $4,200 is kind of irrelevant. So long as we stay above $3,000, the cash flow is going to speak for itself, and we'll see capital start to flow into the equities.
Yeah, and I'd go further. I'd say that that bottom line number is probably lower than $3,000. But I'm still not, again, as you said, we're not in the position on this interview to give investment advice, but I'm still not convinced that gold price doesn't have upside. In fact, I'm convinced of the opposite, that there's still significant upside in the gold price.
All right, so let's get into Allied Gold. We've had you on in the past, but there's going to be people who are watching this interview for the first time. They're totally new to the story. So can you just give us a general framework for sort of what the high level overview for Allied Gold is?
So we're a mid-cap producer. We produce at the present time from two mines, three mines. Two of the mines are so close to each other that we treat it as a complex. So if we call that one operation, and then two mines, those two mines and complex and the other produce between 375 and 400,000 ounces per year. We're going through an optimization program on those. And then that mid-cap company is underpinned by two tier one assets. One of those tier one assets is in Ethiopia. We're in development on that mine. By the middle of next year, so June of next year, we will be at the point where we're producing gold. We start commissioning in April of next year, mechanical completion just before that. We're already in construction on the power line. That's an important part to the development of that project because power is so inexpensive in the country. at roughly one third to one quarter of the cost that we pay even in a robust country like Canada that has so much power coming from hydroelectricity. So the bottom line is we'll be producing close to 300,000 ounces per year at all-in sustaining costs of below $950 per ounce over life of mine for many reasons, one of which is inexpensive power. The other one is Sadiola, and Sadiola today produces close to 200,000 ounces per year, but with a multi-phase expansion by the time we're complete in late 28, early 29, that mine will be producing between 350,000 to 400,000 ounces per year, depending on the year. Very long life. We already have roughly 10 million ounces in inventory as measured in indicated ounces. And so a mine life that is in the range of 19 years at that production level, all in sustaining costs of about $1,200, $1,300 per ounce. So it's a mid-cap company with a very decent production base today of roughly 400,000 ounces that increases by next year to 600,000 ounces, a couple of years after that to closer to 800,000 ounces. But more importantly, it's not the growth in the number of ounces, it's the growth that contributes to cash flow and EBITDA, because all these new ounces are coming in at lower costs. And on the existing operations, with all the steps that we're taking to optimize them, they will be producing gold at lower cost as well. So the combination of all of that in this robust gold market is that we generate some impressive EBITDA, impressive cash flow, impressive free cash flow beginning next year. And that's what defines the company. So it's a growth company, but the focus of that growth is not so much on production, which is spectacular, but even more spectacular is the growth in cash flow and EBITDA.
So we've got uh, effectively three assets here, producers, if we combine the two in Cote d'Ivoire, with Sadiola in Mali, Kermak in Ethiopia, and then the two in Cote d'Ivoire. Um, so, what can you tell us about the royalties or the tax regimes that exist in each of those? Is it very onerous? Is there anything that our audience should know?
Well, the best way to look at this is that I struggle with what is and isn't onerous because in many jurisdictions we have to look at more than just what's the royalty rate, what's the tax rate. We also have to look at how long does it take to get permitted, how long does it take to develop the operation, is the capital cost less in one jurisdiction versus another. Unquestionably, the royalty levels in a country like Mali are higher than they are in many other countries. They changed their mining code in 2023. That got decreed in 2024. We comply with that mining code, and the royalties are higher. But in part, the royalties are higher because they have it's called an ad valorem tax. So it's a royalty based on gold price. The higher gold price goes, the higher the royalty goes. We still make a profitable margin on that, but the amount of dollars that go to royalty increase as well. And in some of these jurisdictions, the state also owns a portion of the asset. In Cote d'Ivoire, it's about 11% for us. In Mali, it's about 20%. In Ethiopia, it will be 7%, but that 7%, I mentioned the power line before. The state has to contribute the funding for the development of that power line through its utility that provides power. So from that point of view, yes, but you know, as a Canadian by nationality, I'm proud of the country. But in Canada, I don't know what the permitting process is, how long it takes, but I estimate that it would take somewhere between 10 years and infinity to get something permitted in our country. So if it can take you 2 years, and if there's less risk of capital overrun because these are more conventional open pit, more conventional CIL plants, then the result of that is that it goes to returns. So I think that the better way to look at something is what's the return, and not just including in that what are the royalties and taxes, but all the other factors that go into what delivers high quality return. Unquestionably, in my mind, is that the returns in some of these countries, particularly in Africa, certainly developing countries, are far higher than some of the developed parts of the world.
So, and I've asked you this before, but the price of gold just continues to just rock. And I imagine you're a guy who sees all sorts of projects across your desk where people are looking for funding and you're finding opportunities. With what's happened with the price of gold, has this sort of changed your guys' internal timelines for project development or potential M&A?
So here's the trick. If you want to invest in a high quality mining company, and that means investing in its management, make sure that that management tells you that they are not going to be looking at gold price to make a determination of what they buy or what they develop. Start with the technical detail. Make sure that you've got that buttoned down. And part of buttoning that down is don't just rely on a feasibility study. Make sure that you've done as much of the detailed engineering as possible before you've actually invested dollars into the project or before you've invested most of the dollars into that project. We try to get to about 95% of the detailed engineering. That means at the level of certainty, scheduling is another one. The level of certainty on the development is far greater. And that's the trick here. The trick is not, hey, let's rely on the gold price. In fact, discount the gold price and focus on the technical detail. And on that basis, you're going to be able to deliver more likely than not on budget and on time. And that's the approach that we take.
So for our audience, I find this to be an interesting question. You're obviously looking at all sorts of stuff and technical reports. Do you put much stock into PEAs and pre-feasibility studies, or for you guys are a lot further past that and kind of looking more like at original data with your own sort of due diligence team that sort of views those documents kind of more as marketing documents, and you guys are kind of doing your own work.
So look, let me answer your question by giving an example of a predecessor company, a company that I founded in 2003 and we sold in 2023. In 2003, you mentioned that my history includes being an investment banker, and part of that history is that I came across a portfolio of assets that included this copper gold asset in Brazil that we were trying to sell as an investment bank. And in the end, rather than sell it, unlike that guy in the commercial that said, I liked the asset so much, I bought it. So I bought into the asset. So to answer your question, that's an example of one where there was a feasibility study. But like all feasibility studies, there are assumptions that are made on certain things. In that particular case, they made an assumption on something called the work index. That means the rock hardness. And so I looked at it and said, well, why assume it? Because the assumption will go to what's the throughput of the plant? What's the energy consumption that will go into it? The harder the rock, the harder it is, the more energy is consumed. And that goes to the economics of the project. It goes to the returns. So here's an asset that was bought for 17.5 million. We spent 240 million to build it. We generated $200 million of cash flow from that copper gold asset from 2007 to 2019. And we sold it in 2019 for $1 billion. So the feasibility study would never have delivered that type of value. Always challenge some of the assumptions that are made. In that case, I challenged the assumptions. It proved to be a great success. So the answer to your question is that's the approach that we take across the board. A feasibility study, pre-feasibility study, all of these things are factors to look at, but then you have to further investigate. We do try to do a lot of that in-house where we rely on third parties. There are people that we've worked with for a long time. And in all cases, we try to complete the detailed engineering to a standard that is a very high standard, well above what a feasibility study delivers.
Okay, so going back to Allied Gold, and apologies, I went on a little bit of a tangent there, but you guys recently published your preliminary Q3 results, headlined by a production of 87,000 ounces, which was down slightly from Q2's production figures. Where does this sit in terms of guidance, and are you expecting to meet forecasts?
So we produced what we said we would in the quarter. If we go back to the beginning of the year, the indication that we gave is the second half of the year is the heavy weighting of our production. The first three quarters are about the same at about 87, 88,000 ounces. The fourth quarter, for several reasons that we can get into, is a very strong quarter from a production point of view, and that also means significantly lower costs as well. And so publicly, we've said that the production expected in the fourth quarter is a whopping well above that 87, 88,000 ounces. It's closer to about 118,000 ounces with significant improvements to costs. And so the way to look at the company then into the fourth quarter, the quarter that we're in, is it's a significant increase, about 30,000 ounces more, but it's also at a margin that is the better part of 800 to 1,000 ounces higher than the average of in the of the second and third quarter. So we can see some pretty robust cash flows coming from the company. So big increase in production, but big increase in cash flows. But the answer to your specific question is yes, we expect it to be above that 375,000 ounces. And then next year, we haven't guided yet for next year. We do provide an outlook, but with all of the things that we're putting in place, removing of waste to get to higher grade ore at our mines in Cote d'Ivoire, the discovery and then bringing to production of new oxide ounces at Sadiola in Mali, the completion of the first phase expansion, which means that we can process more of that fresh ore, which is harder rock than the oxides, through that plant. The result of all of that is that the production platform next year from those mines will be closer to 400,000 ounces per year at better costs. And then Kurmuk in Ethiopia comes into production, and that's really the barn burner here. That's the one that's, to use that baseball analogy, because the Blue Jays have made it into the World Series. It's the out of the ballpark home run.
So when would we expect to see the expansion at Sadiola begin to contribute to the production numbers?
So we begin this quarter.
Okay.
So the actual completion of the first phase expansion completes in December. So we'll see it by the end of the year, by the latter part of the month of December. But we're already beginning to see some optimizations and improvements in that operation as a result of better grade control and the discovery of new oxide ounces. And when you discover something, you then have to make sure that you've uh, uh, drill tested it, and that means tightening the drill spacing, doing the development work, and then doing all the work that's required to bring it through the production process. So with that, we're expecting to see a stronger production coming from all of our mines, including Sadiola, in the fourth quarter.
I got one more question for you. I got to sneak in here. We did a video recently on a company called Sendero Resources. We saw that you were buying open market in it. We had a chat with the management team, and they got us a little bit amped up about it. What drew you to take such a large position in this company?
I saw your video, and well done. I mean, you did a great job of describing I could not do as good a job as what you did in describing what the investment thesis is. I'm an investor. I'm happy to be a sponsor of it. It is a small company with a copper gold asset. It's a large land position in the Vicuña belt in Argentina. This is one of the largest land positions on that Vicuña belt. It is next to some of the big elephants on copper gold opportunities, including Lundin Mining's projects there, including Jose Maria and others. What do I like about it? I like the land position. I like the fact that there's been this exploration in the past. I like that it shows mineralization. It's never been drill tested at depth, although it appears to be open at depth. And the management took over the company. They asked for my support in investing into the company and bringing a new set of investors. They consolidated the share position, and then we're moving forward. They're moving forward from there. So what I like about it is that the structure is very similar to what we see with some of those other assets. And look, let's face it, sometimes someone else does the intellectual property and you can take advantage of it. So 20 years ago, no one would have assumed some of these big elephants on copper gold in that Vicuña district. But with the work that's been done by Lundin, that's been done by others, there's a lot of intellectual property that we can now rely on, we can lean on to say, what are we looking for from a structure point of view? Where are there faults that allow for the dissemination of gold and copper? And as I said, there's been drilling here that has historical drilling that shows that there's significant mineralization closer to surface. The trick now is to drill closer to at depth and to determine whether or not this trend continues to the northeast. If it does, and I believe it does, then we've got an impressive opportunity. So it's trading at a market capitalization in the range of $20 million. But this is one of those, again, to use that analogy, one of those out of the ballpark home runs, if it proves what I think is there. And that's why I've invested in it.
Yeah, and what caught our eye is I don't know you as somebody to mess around with companies that have $20 million market caps. That's not really your MO. So I thought it was particularly interesting, and that's kind of what got us to take a position. So we're going to be following the story closely, and I appreciate you taking the time to go through your insights, and also for sitting down with us today. It's always a pleasure when we get to sit down. I know our audience loves when you hop on here, so thanks for taking the time, Peter, and hopefully we can do this again soon.
Look, you let me know when you'd like me to come onto your program. I'm happy to do it.
Thanks, Peter.
Thank you.
All right, everybody. Thank you for watching. If you enjoyed this conversation, do me a favor, smash that like button, subscribe, and ring that notification bell. Also, if you want more mining content, check out our website over at thedeepdive.ca.